That's what you really got to look for, especially if you're looking for that private market alpha, is what is this manager's, what is this company's right to win, and are they going to maintain that opportunity?
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
All right, welcome to this episode of The Bull of Wall Street. My name's Talley Leger. I'm the Chief Market Strategist at the Wealth Consulting Group, and I'm joined by my friend and colleague Jim Worden, our Chief Investment Officer. And we're pleased to welcome our very special guest, Matt Malone, who's the head of investments at Opto. Welcome to the show, Matt.
Thanks, guys. Thanks for having me. Super excited to be here and talk to you today.
100%. So I got to tell a little story about how we met. I think it was at a Titan Investors conference down in your neck of the woods, right? DC area. When was that?
It's probably like almost a year ago. I think it was last summer. Not quite summer here yet, but it's feeling like it's summer.
I think you're right. And I'm actually attending another one. I think it's later this month. So maybe we can have a little reunion. I guess it depends how the podcast goes, right? So I wanted to ask you, as a private markets expert, you know, we are macro, micro, and markets people, and we follow the space avidly. And I took a look at Blue Owl before we hopped on. It has been in a very kind of visible bear market, I want to say, since the beginning of 2025. So nothing new, but quietly basing since March. What do you think's going on here? Do you think that the worst of the downward pressure is behind us for the private market space?
Well, we want to talk about Blue Owl specifically, or private markets in general, because it's a lot bigger than the headlines would suggest. There's a lot more going on. But
think of it as the poster child for some of the challenges facing the broader space, and you can pivot anywhere you want to go.
Sure. So you've got a publicly traded asset manager in Blue Owl, and then you've got all the underlying private market vehicles that they run, drawdown vehicles, evergreen vehicles. And I think most of what we've seen in the news, and this is a similar setup to other large asset managers, Blackstone, KKR, other folks that have entered the private market space and are building out wealth distribution. I think what's somewhat unique about Blue Owl is they really leaned into wealth distribution. They were started at a time when wealth was, really putting a lot of capital into private markets. They leaned into that. So I think they do have a lot of exposure in the wealth space, maybe more than some of the other large asset managers and the traded ones. I think the noise around redemption pressure has certainly pressured the stock. I think what we're seeing in terms of where we go from here is certainly a good lesson for everyone to learn. I think Blue Owl takes a lot of heat in the news, but the behavior we're seeing is something that we talk a lot about in private markets, which is you need to be a long-term investor. And if you're not a long-term investor, whether or not you're in a semi-liquid structure, or some people don't want to use that term anymore, or a drawdown structure, or whatever it is, if you don't have a long-term mindset, you may want to rethink how you allocate to private markets. If you're thinking about allocating and trading in and out of these deals, whether or not they're semi-liquid or locked up, I think you're going to have a hard time. So is the worst over for private markets? I actually don't think it's as bad as the headlines have made it out to be. I think if you actually look at what happened and what triggered all this, it's kind of interesting, and it comes from a long line of how the private markets has been built out in the wealth space. In the old days, when it wasn't the hot, fun thing to do, when all that big asset managers were playing in it, the structure that was often used for this type of vehicle was what we call a life cycle fund, where you raised money into a fund, and you typically would say you raise money for 2-3 years. The fund would go through some seasoning period. It may or may not have a small redemption program, maybe not. And then it would have a liquidity event at the end, right? So you'd say in 7 years, 10 years, we're going to list, liquidate, or merge. And the vehicle that got a lot of attention from Blue Owl was really one of these old life cycle deals. And they initially looked to merge it into another vehicle. The market went sideways as it was happening. They pulled that back. And then they looked to orderly liquidate it, which is actually something that people in the market have talked about a long time. Is why did nobody ever liquidate these portfolios? If you're in the institutional channel and in a drawdown fund, you typically go through a natural liquidity event. You draw capital for a number of years, you season the portfolio, and you give the money back. And what happened was, because of all the frenzy around Blue Owl, when they started selling assets, which was basically the liquidation strategy, the merge strategy didn't work because the market went sideways. They went into a liquidation strategy. They got beat up for that. Whereas that's something that in the old days, a lot of clients really wanted. So zooming out on all this, I think the market continues to evolve. The private wealth and private market intersection continues to evolve. I think we went through a phase where we tried to make one structure fit all asset classes. And I think what we've seen is that doesn't really work. There's a lot more innovation that I think we're going to see in structure in this space, where we do a better job matching structure to strategy, where we set better expectations with clients around when they can get liquidity and when they can't, and what the repercussions of those things are.
So that's encouraging. And I would just say, just to help frame the next part of the conversation. So we do have an institutional style of money management. I mean, that's my background, and we are allocators to your point. But maybe I'll ask you more of a philosophical or theoretical question next, because you hit on them already. Given the challenges around opacity and pricing and volatility, and redemptions and holding periods, all that stuff is part of it. How should Jim and I think about making sure that we are properly compensated for those illiquidity premia?
Yeah, I think that's a really, really important point you make, Talley. Like, that is something you 100% should be thinking about. Am I getting any additional benefit from the liquidity I'm giving up? That should be the first question that anyone's thinking about when they look at private markets. A lot of times the first question is what are the fees I'm paying? And that's relevant. But honestly, I think most people should be thinking about net of fee returns. And if I look at the net of fee return, is this investment giving me some additional return profile, some non-correlation or diversification benefit? Why am I investing in this? In most of private credit, it's been above market income. That's what people were looking for. When we were in a ZIRP environment, and this is really what drove a lot of the growth in private credit in the private wealth channel, is we were in the ZIRP environment for a very long period of time. You've got 0% interest rates, very low interest rates in public markets, and you got 8% coming out of a non-traded BDC. That's an 800 basis point spread. You're getting paid a lot. You're getting paid a lot. That's a lot on a a kind of a fixed income type product to give up some liquidity. And then I think what's happened more recently is, as interest rates have gone up, the spread between what you can get in a public or more liquid strategy and what you could get in a private strategy has compressed, right? It's not 800 basis points anymore. It's maybe 300 or 400 basis points, depending on what you look at. So that's a super important question. And I think the dynamic changes. Maybe as an investor, you say, you know what, it was really worth it to me at 800 basis points, but at 300 or 400 basis points, I don't know if that's worth it to me anymore.
Sure.
So I think that's what you should be thinking about. What is my goal at investing in private markets? Is it income? Is it non-correlation? Is it growth? And then what is that premium I'm getting or expecting to get by investing in whatever private market asset class I'm investing in: venture, private equity, private credit, real assets, whatever it is.
So Matt, I just got to follow up on what you talked about a little bit about private credit. I mean, it feels like we have got kind of this baby going out with the bathwater scenario, because there's really not a whole lot of areas where there's bad stuff happening. And Talley and I actually got to meet out in New York last week and meeting with a bunch of managers, and one of the managers is kind of in that space, and they were saying, hey, look, not all private credit is low quality direct lending. A lot of it is asset backed. A lot of it is investment grade.
Yep.
But I feel like even then, some of the, private credit managers kind of got punished for it. So like, do you think that we're through the worst of this? Is this, we're going to kind of get back to normal from here?
So, well, let me hit on your first point, for which I think is super important, which is this continues to be part of the education process as more people are exposed to these asset classes. Is if you think about public equity markets, nobody says I'm never investing in equities again because one stock went to zero. That never happens, right? People say, oh, well, I'm gonna focus on the tech sector, or I'm gonna focus on large cap, or I'm going to focus on small cap or growth or value. There's this whole, there's a whole box of different styles within equities. And then we've got like private credit being treated as like this one thing, right? And it's not. And where a lot of the capital has been raised is in upper middle market, primarily upper middle market. So larger companies, direct lending. So providing loans to large private companies that generally are sponsor backed, meaning a private equity sponsor owns the equity in that deal. That is where the vast majority of capital has flowed in private credit. That's what most of the activity is in these large NAV non-traded BDCs, is flowing into that part of the market. But within private credit, even within direct lending, you have lending to true middle market companies, lower middle market companies. Yeah. You have unitranche lending, where you're lending the senior and junior part of the capital stack. You have mezz. You have all different types of styles. You also have a very important part of that business is how you manage your balance sheet, because all of those businesses are levered generally. You're levered as
paid in kind interest.
Well, there's PIK interest, there's cash, but as a manager, if you look at the balance sheet of any BDC, they're typically running 1-to-1 leverage, meaning if I raise $100 from my client, I get $100 of borrowing. Now I have $200 of lending power, right? So I can make a $200 loan with every $100 I receive from when I'm raising equity. That's a huge part of this equation. The banks are generally providing a lot of leverage, also the securitization markets. So the way all these entities borrow, it has a huge impact on the return to investors, on the amount of risk in the structure. So there's all kinds of, and that's just direct lending. And then, as you said, there's asset-backed lending, there's real estate lending, there's all different types of private credit that have different risk profiles and provide different exposures to investors. So I think that's where we're going, is we're going to see, this big private credit bucket start to get cut up into all these different style boxes and risk profiles, and people are going to have a more nuanced view of where they want to invest in private credit at a given time.
I guess the other thing is people were thinking that all of this was going to software companies that were being disrupted, right? That's kind of the other narrative, but that's not true either, right?
There's some truth to, like any story. There's some truth.
Yeah.
There's some truth to that. And I think that is where there was demand. When you think of the private equity sector, private equity is backing a lot of technology companies. SaaS companies were growing very fast. And so the private equity folks generally want debt to meet their return profile.
Sure.
There's definitely exposure there. But as you said, not every manager has the same tech exposure. Some of them are more exposed to tech. Some of them are not exposed to tech at all, particularly if you're in, if you're a lower middle market lender, you probably have much less tech exposure. So yes, there's some truth to it. Yes, I'd certainly be keeping my eye on that. I don't think all SaaS businesses are going to be put out of business tomorrow. But, the more highly levered, the ones that aren't sticky, the ones that are not adjusting and implementing AI within their existing businesses, they're going to struggle.
Let me ask a manager question, and this one's really for both you guys, Jim and Matt. You can flip flip for it. But because you were just talking about managers, Matt, maybe there's some research on this, or you've done it, you've looked at it. How much of private market performance is actually manager selection versus simply being in the asset class? That's a good one for you guys.
It's a great question. Jim, you want to take it first?
No, you go ahead, Matt.
Look, I think, as you guys know, and what you're probably leaning into is there's wide dispersion generally within different asset classes in the private markets in terms of return profile. I think, that we like to tell that story as manager selection. That's a piece of it, but there's also a piece of it, like if you just have these big buckets like private credit, like if you put everything in there, there is going to be some level of strategy selection that's going to have an impact on that. So it's really a little bit of both. But that is super important. And I think that also, the other impact you have to look at is, different managers have different fee structures. They have different incentives. That's what we spend a lot of time on here is the manager aligned with the right outcome for the client? Is the strategy right sized to the market opportunity? But you can also take a view, like people do in public markets, that maybe I don't care as much about alpha. Maybe I just want private credit beta, and maybe I want that private credit beta for as cheaply as possible. And if that's your view, if that's the exposure you want, that's becoming more broadly available in terms of like some of these evergreen vehicles. I think fees have compressed significantly over the years. When I started in the business, when the early private credit vehicles were out there for the private wealth channel, it was a 2 and 20 business. It's now a 125 and 10 or 12 business. There's even some more nuance to that, but the fees have come down a lot. So I think that's when I'm looking at deals, I'm thinking about, what am I paying for here? And if I'm getting beta, that sector's beta, whatever it is, upper middle market, direct lending, private equity, then I want to pay as little as possible for that. I should be paying as little as possible for that, just like you do in public markets. And if somebody's generating alpha and doing it consistently, then I'm willing to pay a little more for that as long as my alpha is still there net of fees.
What do you think, Jim? You're our resident product expert. Do you agree with that?
Yeah, 100%. Well, I mean, and I think it really comes down to what the investor's intention is, right? So if their intention is saying, I want this exposure, but I'm okay with getting beta, then it should be cheap, right? And actually now there's more and more this innovation with publicly traded types of strategies that would capture some of the beta. Maybe not all of the beta, but they capture some of the beta for private equity. Now you've got private credit in a ETF wrapper. In some cases, it's not 100%, but like there's something there. So I think if your intention is to say I want a very diversified portfolio, I want exposure here, but I just want beta. This, I guess, would be similar to like a hedge fund replication. I just want the beta. That's very different than saying, give me the best managers and I'm going to do the due diligence. And I don't, by the way, I don't mind paying the fees, but I want the best returns. And, of course, with the due diligence, you don't always know with perfect foresight who's going to do well and who's not. And so there is that dispersion, but that's kind of my take on it. So I agree with everything you're saying there.
I think the one thing, in terms of the replication strategies that I've seen is always challenging for, some advisors and clients ultimately is if you are, we can have this debate if you guys want to, but if you're investing in private markets for the stability, right? So people like to see we're not moving up and down every day. We're slowly marching up, or we're getting the same dividend. Whether we believe that's real, we can talk about that. But some people want that value that as part of the experience of investing in private markets. Is it's just a more consistent, less volatile experience. And when you start to try to replicate that in a public wrapper, now you're introducing public market vol, and that piece of the experience is taken away. So again, it's like, what is the outcome you're looking for here? If you think long term, you can still generate a good return and you don't care about the volatility and you're not going to look at it every day, then maybe the replication strategy is right for you.
So Matt, we had Cliff Asness on the show a while back. He was quite outspoken about the volatility question. I think you were alluding to there. So I guess, maybe that's a good one to your point to kind of dig into a little bit. How do we know, how do we just trust without even verifying what the true volatility is? What can we do to address that?
So I think we got to go back to why we care about volatility.
Mm-hmm.
I see a CFA charter back there, Jim. I mean, vol is meant to be a proxy for risk, right? Like that's why we care about vol. We said we like in the public markets, we say vol is my risk proxy. I look at standard deviation, this is how risky this asset is based on how it moves up and down, right? So that's why we care about, at least I think that's why we care. But that is where the focus on vol comes from.
Sure.
And hedge funds focus on limiting vol for various. So that's sort of the backdrop. Is we've said, okay, we want a shortcut for measuring risk, and in the public markets, we're just going to use volatility for that. In the private markets, for the most part, we can't use volatility for a risk proxy because we don't have regular marks. And I could argue with you guys too that the public mark is not always, there's price and value, and public marks are a price. They're not necessarily a value. Public markets trade off all the time for reasons that don't make any sense. So we can argue, we can say, hey, public marks maybe aren't that great either, but it is a price that you can clear the market at.
Sure.
And if that's your belief of what value is, okay. But I think in private markets, it's just a little more work to determine what your risk profile is, in my opinion. Like there's no shortcut. And that's why, we have people doing a lot more research and diligence because you're locked up for a while. You need to have your own risk proxies for different asset classes. So leverage would be, how much leverage is being used in this strategy could be a proxy. What's the loss ratio? Like, if I'm a long-term investor, do I really care about this? No, I care about am I losing? Like, how much money am I actually potentially going to lose? If you look at the long-term statistics on private credit, like the default ratio is not that high, and the loss ratio is even lower, right? Because they can do workouts, they can recover. So if I'm a long-term investor, isn't that what I really care about?
Yeah.
Like, what's my loss ratio? And how much leverage am I putting on this strategy, and what is the outcome I'm looking to get, and what is the likelihood that I'm going to get that outcome? And so, yes, volatility is masked in private markets, but I also think there's just this over reliance on volatility because that's the shortcut we use in public markets. And I think what we got to do is we all have to get smarter about what's the right metric for risk in private markets, and it's a little bit different for each asset class. It's different for private credit than it is for private equity than it is for real estate. There's some things that rhyme in there, but it's not all the same.
Well, and then too, with that, Matt, there's the whole investor behavior component of it. Whereas if the investors see the price moving all over the place, then that alone can create some volatility, or it can amplify the volatility if they don't see that. And they know that I'm going to hold this for a long time. This is a business that I like. And, it's just like any other private business. They expect that over long periods of time, it would go up in value, and they're not going to be looking at it just like someone doesn't look at their building every day to see how much is it worth tomorrow versus the next day, right?
That's completely right. I mean, but one of the things kind of built into what you said is actually something that some people in the industry used to say, which I never found very convincing, which is we're protecting investors from themselves. I always thought that was the worst kind of cop-out answer. But, we don't mark things because we're protecting, it's like behavioral finance. We want to protect people from themselves. Okay, so you're basically saying that you're trying to pull over the wool over your investors' eyes so that they don't pull money out. Like that is not, I don't think that's the right approach at all.
Sure.
I think investors should be educated on what risk they're taking and, what repercussions they have, what liquidity they have. It shouldn't be like, oh, we're just masking this for you so you don't pull out at the wrong time. That's not the right, and that's why people have financial advisors. That's why people work with professionals to hopefully tell them, hey, just because the market went down today, it's not the time to hit the sell button on everything. It's the same thing in private markets as in public markets there, that maybe if the market went down and maybe it's for an emotional reason, maybe that's actually the time to buy or the time to double down rather than pulling out.
Well, that's why I started the whole thing with that question about Blue Owl. Jim and I will take a look at things that other people don't want to buy, so that's the contrarian value investors in us. Of all the inner voices that we listen to, that one does come out sometimes. But I should have done a better job, Matt. I apologize for those who are unaware. Opto is a fast-growing private markets platform. And I wanted to ask another question. Do you guys have, like us, an investment committee? Do you do deals?
We do, yeah. We have an internal investment committee. So we are a fintech platform. We built software to help wealth management platforms build diversified private market portfolios. We do sourcing and research and diligence. We have an internal investment committee where we are actually also an RIA, so we are regulated. We are a fiduciary. All of those good things. I started life as a lawyer. I'm still licensed, but those things do mean something. Being a fiduciary does have teeth. It means you have to treat everybody fairly and equally, and we think that's super important to our business. So we do have an investment committee that sits on top, and depending on our relationship with our client may give us probably just like you guys, may give us discretion to make investments within a certain mandate for them, or we may sort of have a joint committee. But ultimately, yes, there's three of us on the committee that are reviewing every deal and approving or not approving every deal. And I have a whole team that I built out here that does research and diligence across all the major food groups within private markets.
That's helpful. So Jim chairs our committee. I'm the macro voice on it. But I want to ask you, what are some of the red flags that would absolutely kill a deal for you guys at Opto?
Yeah, I mean, so when I think about diligence, I kind of bucket it into three areas: strategy, sponsor, structure. I like alliteration, so it makes it easy. So we talked about strategy, right? And I think that's pretty obvious what that is. Is this a strategy we like? Does it have the ability to generate the returns we're looking for? Is it right sized? Those are the type of things in strategy. Sponsor is the management company. So this is like, who's running the deal? Is it appropriately staffed? Do they have the right financial resources behind them? Are they committed to this business? And then structure is some of the stuff we talked about at the beginning. What is this strategy wrapped in? Is it an evergreen wrapper? Is it a drawdown? What are the fees? What are the expenses? Is it reasonable? You can have red flags in any of those areas. I think one of the things, a few of the things that are really obvious up front that I think you have to focus on is alignment, conflicts of interest. I think those are huge in private markets. It's very easy to have misaligned incentives. Fee structures, we need to make sure the fee structures are aligned with the outcomes so that investors are doing well if the manager is doing well. That's super important. Looking at also, is the manager committing capital to their own strategy? Are they eating their own cooking? That's a really important piece of the equation. So those are the types of things I think on their face. The place where I've seen a lot of things go wrong over the years in private markets is the conflicts in affiliated transactions. If managers are doing deals across the platform, if they have different funds that aren't aligned and are doing different things that may be investing in the same things, those are where things can really go wrong in terms of something like outright fraud or losing money. Look, there's as you said, Jim, there's always the risk that the strategy is not going to do well. We're all investors, and we know that sometimes investments go sideways. we view our job as, of course, we want to pick the best investments, the ones that we think are going to do the best. But we want to make sure that if something goes wrong, it's because just the investment didn't work out the way we thought it would, not because there was some structural issue or some misalignment of interest. That's where you have I think a real problem and a real risk.
Interesting. And Matt, what's really the difference between Opto's platform and some of these other platforms that have been out for a long time? I'm thinking like iCapital and Case. How are you guys different than those other private markets platforms?
That's a great question. I appreciate you bringing that up. It's funny you say that, because I told some of my colleagues a few years ago, I said, my goal is to make sure that I never hear that question again. because it's a totally fair question. But if we're doing our job, so the core tenets of what we want to build when we found Opto was, one, going back to what I said about diligence, is an aligned platform. So we're an RIA and we serve RIAs, and we are a fiduciary. We serve fiduciaries, and we make sure that we don't have any conflicts of interest in terms of what we're doing from an investment side. So we're doing everything we can to limit conflicts of interest and be aligned with our clients. And what that means is we're not picking particular deals because we're getting paid to distribute that deal, or for other financial reasons. We are aligned with our clients to bring them the best of what we see that's aligned with their investment strategy. So that's core to what we do. Also, we are very focused on like a full portfolio approach. So looking at private markets as a long-term allocation rather than a trade, rather than lots of individual trades, which is how it's been done in the wealth channel historically. We've seen a lot of people do, I'm going to put a few bucks in this deal, a few bucks into that deal, can be a little haphazard. We think of private markets as should be a long-term allocation to most investors' portfolios. So how do we build a diversified portfolio of private markets that has the right long-term? So that's really the core of what we do. We're, of course, we think our tech, of course, is the best. We're Silicon Valley backed. Our chairman is Joe Lonsdale. He's a well-known multi-time founder. He was the founder of Palantir in his 20s. He founded Adipar, which is a huge business in the wealth space. So, we're able to hire really good tech talent to build technology to really help people scale these programs, because there continue to be a lot of operational issues within private markets when it comes to still really simple things: subscribing, redeeming, reporting performance correctly. All of those things, especially with independent advisors who have their own tech stacks, all of those things are still complicated and are still not solved. So we spend a lot of time trying to solve those problems for RIAs.
Interesting. So it feels like this is more of a partnership relationship with other RIAs rather than kind of the transactional, here's a platform, do whatever you want, knock yourself out. This is more working with you on that. Is that right?
Yeah, exactly. It's meant to be a partnership. It's not meant to be a menu business. It's not meant to be self-serve. It's meant to be the white glove, joint venture with our partners.
Hey, Matt, you were talking about distribution just now. So maybe that's another question I can ask you. Given the democratization, we'll call it, of alternatives, has that trend improved investor access, or has it just kind of expanded product distribution?
Both. That's a hard one. I mean, I think it's evolving. I think it's evolving. I think people have been talking about democratization a hard time. What that meant for many, many years, until very recently, honestly, was basically two things. We had non-traded REITs and non-traded BDCs, which were basically core real estate and upper middle market direct lending. Those are the two main categories of things that you saw broadly distributed within the wealth channel. That has changed a lot over the last few years. We're seeing a lot more asset classes be more broadly available. PE has sort of made its way in to the wealth channel, into some of the more broadly distributed products. And now we're seeing venture make its way in. I think, all the excitement around Anthropic and, SpaceX IPO is certainly helping some of that. So Yeah, both. I think there's like everything, there's good and bad to it, but I think people getting more educated and is a good thing. I think people having more access is a good thing. I think we'll continue to have some bumps along the way. It's not going to be perfect, but I go back to what I said earlier on, which I think is the market really wanted everyone to be like fit into some very specific structural boxes for a long time. And I'm really seeing a lot break out from there. And I think that is going to create some really interesting opportunities, both for managers and for investors who have different risk profiles, have different liquidity needs. If you think about the venture space, we've seen a lot of new products launch. We've seen some that raise money privately and then list on an exchange. We see evergreen style vehicles. We see things that are somewhere in between. That's the kind of stuff I like to see, and I think ultimately is good for investors. And it will continue, I think, to push fees down for everybody, which I also think is a good thing generally.
So Matt, I've got a question, just kind of following up on that, with the appetite for venture capital and companies are staying private longer, and you hear about SpaceX and they're going to debut at probably 1.75 to $2 trillion when they go public, and then you've got Anthropic and OpenAI. So there's a lot of interest there for investors, and that I guess the good and the bad, right? Because some people aren't always educated about the best way to get in here. But then there's also this idea of tokenization and tokenizing buildings, tokenizing things that are less liquid. Do you have any sense of is this where are we going with this? I mean, it's part of me is excited, part of me is it's a little bit scared because I feel like sometimes we do too much, right? The marketing folks want to push things out, and maybe we're not quite ready. But like, what would you say about those?
Well, so there's lots to unpack in that question. So first, you talked about some of the venture things, then you went into tokenization. So we're hitting a lot of hot topics. Look, I think the venture. The thing I'm most concerned about, I'd say, with all the excitement around venture and what we're seeing here is, and you saw it recently with Anthropic announcing they're kind of cracking down on who's holding shares and how they're being traded. Whenever there's kind of a gold rush like this, there's got to be some things that I think go a little bit sideways. And so, I've definitely seen some things in the wealth channel, some different type of structures, some SPVs that don't seem to meet the criteria that we talked about in diligence. Like, what are they really holding? What fees are they charging? Is there any alignment between the person putting this together and the investors having a good outcome? When you ask somebody says, "Hey, I got Anthropic," and you say, "Well, what was the valuation?" "I don't know." "What were the fees you're paying?" "I don't know, but I got Anthropic."
What is it? And each SPV may be a little bit different too, right? Or do they get the actual shares?
100%. And so I think that is something we're definitely keeping an eye on. We see a lot of deal flow because of where we sit in the market. But there's a lot of people that don't see a lot of deal flow, and if they see the one Anthropic SP, they make it very, justifiably excited because these companies are growing very fast. But you have to be very careful on the tokenization thing. I think there was a lot of excitement around tokenization for a while. I don't see as much movement towards tokenization. I certainly think there could be some interesting things done there, but they maybe could be solved with other existing technologies as well. We have a somewhat more blockchain, crypto friendly administration here in DC that's trying to make it easier for people to transact. But ultimately, it's going to have to be as easy or easier than existing venues for people to participate in tokenization stuff. I just haven't seen it. I don't know if you guys have been seeing that, but I haven't seen as much activity with people pushing towards tokenization.
No, I've only just seen like with T-bills and things that are already super liquid, they're tokenizing that. But
Yeah.
I'm a little
Well,
bit, skeptical on like buildings and private markets because, like, unless you have a large enough market that prices and correctly values the whatever it is that's tokenized, then I don't know how that works.
Yeah, you
well,
come back.
I have seen some headlines recently
Mhm.
in the news about this movement, or um, maybe impetus is a better word, towards tokenized trading of stocks, publicly listed
Yeah.
shares.
Mhm.
So, I mean, it's out there. It's an idea. What were you going to say, Matt? Sorry.
No, look, it's definitely out there. I personally haven't seen a system or a platform that is using tokenization that's making it significantly easier to transact. And as you said, Jim, like, how are you going to create a market clearing price? You have to have some volume
Yeah.
to make it work.
Well, maybe a
Interesting.
silver lining there would be completely disrupt this inefficient housing market that we're all involved in. Would be interesting if every house was a token and standardized, and there was a clearinghouse, and you could buy and sell homes just like stocks. Anyway, I digress. That's crazy talk. I know. I do this every once in a while. But well, I want to give you the last word, Matt, because we're kind of coming to the end of
Well,
our
I've
time here.
got one more question for Matt before you get that. So
Okay.
you go ahead, Tally.
Well, I was going to say, what is one question that every allocator or advisor should ask a public, or I should say private market manager that they don't?
So I think a lot of folks just don't see enough deals. I think it's really important to see a lot of volume, and there's no place you can go. There's some data sources like Preqin, PitchBook, other. I don't want to, but there's no complete database of private market funds, deals, anything like that. So if you haven't seen a lot of deals, and if you're seeing something for the first time, this is the first time you've ever seen a venture fund or the first time you've ever seen a private equity fund, it's going to sound great. Okay.
Yeah.
So I think that, without seeing a lot of volume, you generally don't know the right questions to ask, and you don't know if the answers are relevant. But I think the question I ask to myself a lot at core, it's an investment question, which is, what are you doing to maintain your edge, and what is your right to win in this market on an ongoing basis? Not in the past, not, past performance is no guarantee of future results. What are you doing that is so unique and different? We talked about private market beta versus private market alpha. And a lot of times you're going to get some very generic answers to that question. We're better at structuring, or we've got better deal flow. And that can't be true about everybody, So I think that's what you really got to look for, especially if you're looking for that private market alpha, is what is this manager's, what is this company's right to win, and are they going to maintain that on a go-forward basis?
That makes sense. So my final question is: so you were an attorney before you got your CFA, and like how do those even compare? I mean, I didn't study law or anything like that, but I know they're both difficult. And what made you decide to go from one to the other?
Well, a funny little story related to your guys' podcast. You had a guest on the early days, a guy named Jeff Chang. I don't know if you remember.
Oh yeah, Jeff. Yeah.
Episodes. Jeff was my CFA tutor. So he talked about how he used to do CFA tutoring.
Yeah.
CFA classes. So I took Jeff's class.
Nice.
Awesome.
So funny little tie-in to your earlier to your podcast. But I went to law. I'd say the commonality between the two is, I think law school teaches you really structured thinking. It's obviously a different body of knowledge, but really what law school is trying to teach you is not really the laws. It's teaching you how to analyze things, how to break up problems, how to look for evidence and support your thesis. And that's really what law school is trying to teach most people, is the way of thinking and of structuring your thoughts. It forces you to write a lot. And so I think that experience of having to go through that rigorous logic process of law school, definitely helped. It's definitely applicable to some of the things that you study in finance. I think particularly accounting, which is like something we don't talk about that much at all, but is super important when you talk about valuation and all the things we talked about earlier. There's very few people that understand accounting that are investing in these vehicles, and the accounting is super important when you're looking at how NAV is struck and valuations. So I think there's a lot of parallels in terms of how you think. Of course, it's a totally different body of knowledge. I mean, for me, I was working in securities law. I was working at a firm where we were doing a lot of deals in the private markets, and I was learning about that stuff. And so, I said, I got to know more about the investing piece of this, because the investing is what's driving all of this business.
Yeah.
And so that's what sort of drove me into the CFA program, was I wanted to really have a deeper understanding of all the investment concepts that were driving all these investment businesses that we were working with back then.
Well, I feel like this it's a good tool set for you, because a lot of the due diligence, when it comes to private markets, is like is it structured, operational? And so having your law background probably helps a lot.
It doesn't hurt,
like that, right?
Sometimes it doesn't hurt. I mean, you always have to, sometimes people don't want the lawyer on the call. But,
you don't tell them you're a lawyer.
Try to keep that tucked away for as long as I can. But yeah, look, it definitely helps. And particularly in this intersection of private wealth and private markets with these 40 Act funds, there's so much of this that's driven by sort of legal limitations, whether it's leverage, whether it's investment allocation is a big piece. There's all types of stuff wrapped up in the legal structure of these private wealth focused, particularly evergreen funds.
Well, Matt, you mentioned Jeff Chang. I feel like Jim and I bump into him every time we're in Vegas for something, a conference or a meeting of the minds. But I'm sorry we didn't see you there a couple weeks ago. But look, I want to thank you for coming on. It was a great hour. We filled it up pretty easily, and hopefully you'll come back on for a future episode.
Hey, it was great to be here. Super fun. I think there's a lot more topics we can cover if you guys want to have me back.
Yeah.
Love the questions. Love we jumped right into it. But you guys are doing a great job, and look forward to seeing the next episode.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.